been emotional. The markets are up, they're down, they're up again. The aftermath of the Fed policy announcement has been anything but clear-cut. But it does seem like we're finishing the day in relatively strong form. Thank you, earnings from Broadcom. Very different story than earnings from Oracle yesterday. And now we try to figure out what comes next because markets have had a chance to digest a little bit. Now perhaps we can get a little bit more clarity. As ever, I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We're going to start with the price action for today. And then from there, we'll have a look at what is lining up to shape what comes next, see if we can't figure out what these markets are aiming at from here. The performance that we see on the board looking pretty solid today. It was a very seesaw kind of day. Seeing the S&P 500 ultimately eke out a gain of 0.4% largely comes down to those Broadcom earnings. That's because tech has been very heavy all day. Nasdaq ultimately finishes the day flat, having been down quite a bit earlier because of those Oracle numbers that came out after the close yesterday. At one point here, the Nasdaq was down as much as 1.6%. And obviously, it's closing the day here with a fractional gain. Now, it's still stuck in the same range where it's been basically since last Friday. So ultimately, the Nasdaq doesn't end up going very far this week at all. On the week, in fact, the index is only up about 0.3% and still under last week's high. So we don't necessarily have a breakout here, but we might have one in the S&P where we are finally through the highs from last Friday and from the mid-November high, right around that 6,900 level. There, we do have what looks like a breakout. And again, earlier today, we were down as much as 1.09, something like this, percent for the S&P, and obviously this is quite the rebound. So looking at the aggregate figures here, it doesn't look like much, just a 0.4% gain for the S&P, just a flat result for the Nasdaq, but nevertheless, given where we were earlier, this is quite the comeback. Now, not surprisingly, looking at the rest of what is going on here, I think it's relatively clear that what we're looking at this point seems to be a sort of coming to terms with what the Fed has given us, and the sort of standstill that we see here on the yields front seems to say that story. Now, what's particularly interesting is what's going on at the front end, because we continue to leak a little bit lower. And of course, the implications of this definitely still on display, it seems, in sort of those things that are sensitive to near-term U.S. borrowing costs. We've got gold up healthily, and of course, silver looks even more dramatic. The dollar is weaker again across the board, down 0.5% against the euro, down 0.4% against the yen. Bitcoin managing a very small gain here, but still looking much more anemic than other measures of risk sentiment. And so we end up here with a situation that seems to put something of a bookend on this week's sort of Fed-focused story, and resolve that despite the fact that the Fed did not come the market's way on Fed policy expectations, the substance of what it did was ultimately embraced. And you can see here, looking at the policy statement, we went through this extensively yesterday, but you can see here, there's not much that's going on. There is more so a change from the balance sheet management side of things, where this part of it comes off the board, and we get this bit added, where the committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities. Chair Powell later came out and kind of clarified what all this means, and the expectations seem to be that we're going to run this through about April or so, so going into tax season. And interesting that suddenly we're getting this, but the narrative from Powell is, look, we're seeing a little bit of a technical discombobulation, as it were, in the markets, where repo rates and the Fed's target rate have kind of drifted apart. And what we're looking at is then a situation where you have a need to sort of make a technical adjustment. And the Fed is ostensibly looking to do precisely that with this facility. But of course, what they've done as a consequence is drive down short-term borrowing costs. And the result, again, has been very sort of straightforward. Dollar is down at a big down day. Yesterday, it's down again today. Metals finally perking up. Finally, for gold, silver has been on a tear, but gold finally coming out of its congestion range and attempting to make some headway on the upside. As far as what Chair Powell said, we're looking at signaling that was not altogether all that dovish, but for that little tidbit. Powell said it's at this point a policy that's in the plausible range of neutral, and that the committee is well positioned to determine whether further adjustments are needed. Not when, but if. Looks like a rate cut is not the best case, though, of course, Powell clarified that nobody's talking about rate hikes, and that opinions are relatively balanced. Now, one would surmise, considering all of the focus on the rebalancing of risks and the dangers that the Fed has suddenly perceived in the labor market, that this is really the essence of what the Fed is saying. They've pointed out, and Powell was very clear about this, that there is about a $60K a month overcount that they perceive in non-farm payrolls numbers. And if non-farm payrolls then are running at about 40K on average a month, with that overcount, you're looking at an average of 20K in job losses a month at this point. And that obviously is something that the Fed wanted to push back on, which is how we got the cut. But the Fed seemingly saying, or seemingly splits down whether you need any more easing after this. Now, on the inflation side, we can see the Fed sees mixed signals with relatively moderated views here. Services inflation is moderating. And of course, the Fed loves to see that because that's where most inflation lives. And on the good side, we can see inflation is going higher, but that's, according to the Fed, a plausible one-off, where once we get past the first quarter, we get through the year-on-year calculation, sort of base effects of seeing that in overall inflation numbers. And according to the Fed, if the tariffs were removed, inflation would be in the low twos. So again, this is how you get the justification for a rate cut. So from the Fed's perspective, they're not going anywhere fast. They're monitoring now, but this sort of backward-looking reasoning is how they talk themselves into a cut this time. Where perhaps the bigger issue lies is in the outlook for next year. The Fed is still at a sort of symbolic one cut. So this obviously forecast for this year has already been realized. We've got the 3 cuts that we were looking for. We still only have 1 cut on the menu for next year, and obviously the Fed is of a different mind than the markets are. They see at least 2 cuts, 54 basis points on the board here, but a little bit of a nod to the positivity that the Fed perceives in productivity and in growth in general. If we note here, the Fed has upgraded growth expectations, and nevertheless, curiously downgraded inflation expectations. If you get more growth but less inflation, that, of course, is a rise in productivity. And Fed Chair Powell was very congratulatory on that, saying he wasn't expecting back-to-back years or several years of productivity gains, but here we are. And so perhaps on that basis, we're starting to creep in the direction of rate hikes in 2027. Now, this is obviously a very long time away and isn't likely to be the driving narrative for policy here for now, certainly not for the market's reaction function. But we do see that there is seemingly a situation here where the market is starting to kind of behave as though what we're looking at is a generally well-supported economy, on top of which the Fed will pour some amount of stimulus. And so, in a sense, this starts to become a question of sequencing. The Fed says 2 cuts, 1 next year, 1 in 2027. The market says, give us both cuts next year, and then you can start looking at neutral to upside bias into 2027. So the markets and the Fed are a little bit more aligned than they have been over the course of this year and next versus what they see now for next year and the one after. Now, we can see, of course, how very critical the relationship here has been between where we start to see rate cuts building in expectation for 2026. And of course, we also start to see stocks building higher. We also clearly see that when the expectation here is somewhat diminished, you start to see stocks get a little bit annoyed. Now, we seem to be through that part of it. We haven't quite cleared out the high, of course. And the overall sum of easing since we established a bottom here has been coming in for next year. Now, if the markets are going to be happy with this, this will be the time that we find out. And of course, what we are looking at next week is a whole slew of economic data releases, many of which are backfilling from things that were missed during the government shutdown. We've got the October and the November payrolls reports. We've got retail sales numbers for October and November. Those are going to be key. We also have the inflation data that we need for November. We never got October and looks like never will for the CPI report, but we are going to get November here, and that'll be relatively time sensitive for what we need to see. No forecast out as yet, it seems, but from the market's perspective, there is no rate cut for now on the menu in January. And in fact, in order to get the probabilities to start looking like a cut is hovering with better than even odds, you've got to get all the way out to April. As it happens, the Atlanta Fed's GDP Now model, limited though it is because of all the disruption in the data, seems to be pointing to something of a slip in the vigor of the economy. Now, on one hand, that, of course, seems to help justify what's going on with the Fed and why they're moving to cut and where their sort of emphasis on this is coming from. But on the other hand, the economy seems to be in relatively solid shape. If we take a look at some of these other indicators, we've been looking at the S&P Global PMI numbers. They show the economy is back to relatively brisk growth here after this weak patch here around the introduction of the tariffs. We're back to levels that were there in the second half of last year. We can see, looking at the ISM numbers, that although manufacturing remains relatively anemic, the situation in services, which is the much bigger part of the economy, is holding up well. And in fact, over the past 2 months has narrowly accelerated in terms of the pace of growth. As ever, this is in the logic of PMIs, as is this, of course, where over 50 is growth, under 50 is contraction, 50 is neutral. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And while manufacturing is in contraction and has been for a while, the service sector seems to be steadying the ship. And that's most of the economy. That's 70 to 80% of the economy. Likewise, we look at the important inputs for the Fed, and we see employment is shrinking for both sectors, but at least for services, it has increasingly slowed in its decline. And inflation seems to be cooling off, albeit more so in manufacturing where things are contracting. Weak demand will do that. Then in services, encouragingly, though, of course, since services is a much larger part of the economy, you're getting a little bit of disinflation even as growth holds up, which is, of course, good news. So from the looks of it, the Fed is well positioned to continue to bide its time from here for at least a few months to see where we ultimately are. And of course, this incoming data next week is going to be a major input. So it is, to some extent, decision time here. We're back at the highs that were there in late October for the S&P as a kind of sentiment barometer. And that has come against the backdrop of the outlook for policy for next year and the year after kind of boiling down to an increasingly less dovish view, starting from about, let's call it, the second half of November 20th. So let's say that's about 3 weeks' time. So the question here is going to be, can the markets defend this level? And will sellers ultimately give us some kind of a swoon here because the outlook on policy seems to be going in a direction the market doesn't like? Or are we through the worries about the Fed because now we've got this tailwind of productivity that the Fed is talking about? Now we've got this economic data from the labor market that ostensibly is going to confirm what the Fed is talking about, and these job losses on net. And so perhaps then we get this kind of Goldilocks scenario where expectations shift back in a way that the Fed is cutting and the economy is holding up. And that, of course, would be the best of all possible worlds for markets, at least for now. In terms of exposure, with all of that in mind, I'm back long gold. It seems to have finally taken out its range. It was really struggling yesterday It was tough, in fact, to make a case for the Fed being as dovish as some other things suggested, in particular the dollar. We'll get there in just a second. But gold finally broke through the range top that's been holding since the beginning of December. That's around 42.60, 70, let's say. And now looks like it's maybe on a path back to 43.80 or something like this. So essentially back to the highs from October or so. And so I'm back on the long side there. Short the dollar. I flipped things over after the Fed because that new program to purchase short-term securities seemed to really take a bite out of the dollar. So I flipped the trade over in the euro yesterday, in the pound today. I'm still short a little bit of Bitcoin, which cannot find any kind of support from all of this risk on sentiment. And that, of course, speaks volumes. So I'm happy to stay short there. And this exposure to the short side in S&P is basically back to where I laid it on. And now looks like maybe it's not going to give us the kind of reversal at these levels that maybe the trade was looking for. So I'm going to have to start to think long and hard with only 8 days to expiration, whether I should just close this with the small loss that's there versus rolling it. And my inclination at this point is to close it and then come back again if, in fact, the highs from October end up being meaningful resistance that holds, and re-entering the position with a little bit of a pause to see what happens at that high, if that's where we're running. I've also gotten long the bonds again, the long end of the curve here. They looked like they were breaking down yesterday, but we get a spirited rebound over the course of the past 24 hours, and we get back into the range here. So holding the bonds long has once again started to make sense. It's a little bit of a seesaw, a little bit of a head spinner here. I got out and then booked a small loss, and now I'm getting back in. So a little bit of a paying for my haste, I suppose, although I wouldn't be saying that if the bonds had crashed as they looked like they might. And so I'm happy to pay for a little bit of certainty here, and so a little bit of extra certainty. Vol here is still tremendously cheap, so outright call verticals is the exposure because it's very cheap to have, and the risk reward is easy on the eyes, as it were. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm likewise writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on Blue Sky and on the platform formerly known as Twitter. If you're watching this on YouTube, like and subscribe. Macro Money returns next week. I'll be back for Futures Power Hour and for Last Call with Chris tomorrow. Happy trading.